Hello everyone, let me introduce myself. My name is Dindi Novia Risma Putri. In this video, I will present material about equity and valuation models. Come on, follow the material. Equity models and valuation. Equity models and valuation are concepts used to determine the true value of a company, especially from the perspective of shareholders. In this context, equity refers to the portion of the company that belongs to the owners after all debts and obligations have been paid. Valuation is the process of estimating how much a company or its stock is actually worth. This is important because the market price of a stock does not always reflect its real value. Investors use valuation to decide whether a stock is worth buying, too expensive, or undervalued. There are several common methods used in equity valuation. One of them is the dividend discount model, DDM, which focuses on the dividends that a company pays to its shareholders. The idea is that the value of a stock depends on how much income it can generate through dividends in the future. Another method is the discounted cash flow (DCF) model, which looks at the company's ability to generate cash in the future and converts it into present value. This method is widely used because it considers long-term potential, although it requires careful estimation. Other commonly used approaches include the price-to-earnings (P/E) ratio and the price-to-book value (PBV). The P/E ratio compares a company's stock price with its earnings, helping investors understand whether a stock is relatively expensive or cheap compared to its profit. Meanwhile, PBV compares the stock price with the company's net assets, giving insight into whether the stock is valued higher or lower than its book value. These methods are often used to compare companies within the same industry. The valuation of a company is influenced by several factors, such as its growth potential, level of risk, overall economic conditions, interest rates, and the quality of its management. For example, companies with strong growth and good management tend to have higher valuations, while high risk or unstable economic conditions can lower a company's value. In conclusion, equity models and valuation are essential tools for making informed investment decisions. They help investors understand the real value of a company and avoid relying only on market prices. However, No single method is perfect, and valuation always involves assumptions and uncertainty. Therefore, it is important to use multiple approaches and careful analysis to make better and more rational investment decisions. Okay, that's about it. I apologize if there's anything missing, and I hope this material is useful for all of us. Thank you.